Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 267 of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. I am blessed this week to have Director of Research and Trading, Mr. Nick Whitaker, on the podcast. Welcome, Nick.
Good to be here, as always. It's been a while since you and I have done a podcast, so this will be fun.
This will be fun. I always look forward to my podcast with you, and tonight's going to be special for us on a personal level. We have draft night for our firm's fantasy football league.
It's a big night.
It is a big night.
It's a big night here at Jessup Wealth Management. Fantasy football is it's a passion of mine, to say the least.
For those that don't know, Nick is hardcore about his fantasy football, so we'll see how this year goes. We'll give you updates as the season goes on. How about that?
Absolutely. Statistics and sports,
Nick's all over it.
So much fun.
Nick's all over it. Nick, I'll turn it over to you before we go into our discussion. I know you're going to review the month and year-to-date performance of the major indices that we track. I'll let you cite the source as well.
Yes, as always, this is as of yesterday's close, the 26th of August. These numbers are coming from Y charts. The S&P 500 is up 1.7% month to date, 17.8% year to date. The Dow Jones Industrial Average is up 1% month to date and 9.4% year to date. The NASDAQ Composite is up 0.7% month to date and 18.1% year to date. The iShares Russell 2000 ETF, think small caps, is down 1.5% month to date and up 9.8% year to date. And the Vanguard FTSE All World ex-US ETF is up 2.1% month to date and 9.4% year to date.
If you fell asleep on July 31st and just woke up and you see these numbers, that does not tell you the whole story of the equity markets in the month of August.
It does not tell the story in the slightest.
Very deceiving.
Yes, very deceiving, a little bit of volatility, but we talk about it all the time. That's why you just, sometimes you just got to turn off the news and take a deep breath.
That's right.
Checking in on the Treasury market, the 3-month Treasury rate is at 5.24%, the 2-year rate is at 3.91%, and the 10-year is sitting at 3.82%. Jumping into big headlines and current events, Fed speak was definitely the topic of the market over the past 5 or so trading days. Chairman Powell affirmed expectations that the Fed will begin lowering borrowing costs next month, making clear his intention to prevent further cooling in the labor market. Quote, "The time has come for policy to adjust." This is a quote from Powell speaking on this previous Friday in Jackson Hole, Wyoming. He says, again, quote, "The direction of travel is clear, is on a sustainable path back to 2% when referring to inflation." Another piece of data came from the St. Louis Fed that e-commerce sales as a percent of all U.S. retail sales increased for the 8th quarter in a row to 16% in 2024. Q2 is up from 15.8% in Q1 of 2024. So pretty steady trend there.
I think that stat will still surprise people, because I bet if you did a random poll on any street in America and you said, hey, what percentage of online sales as a total of all retail sales, what's that percentage done online? I bet you the average American would guess substantially higher than the mid-teens.
Yeah, I think I would have guessed higher than the mid-teens. But I'm familiar with this data point. So.
I know. I think the average American, I bet you, I'm gonna spitball on this. I bet you the average American would say 30% plus. 30 to 40% would be what I think the average American would guess. And I think it's nice that we reference that, because based upon the data, it's in the mid-teens right now. And I think that'll surprise a lot of people.
And I think that's another reason why for years and years, people talk about the e-commerce trade and that continuing to grow.
Yeah, has it reached saturation? Are we at a point to where it's
and
and obviously you're seeing that trend.
Yeah, maybe not though.
Yeah.
You know, the last major headline just for investors to be aware of is that Nvidia earnings are tomorrow, Wednesday, 8/28 after the close.
Yeah,
So you'll
and I
see
think
that
you're
reaction
highlighting
on
that obviously
Thursday.
due to the it's a heavy weight within a lot of these indexes like the NASDAQ 100, S&P 500, and it tends to be a broader sense of, say, risk appetites in the market. This is not a recommendation for or against Nvidia, but rather it could definitely garner some headlines over the next several days.
Yeah,
Right?
absolutely. They're kind of a leader of the AI trade, so to speak. So depending on what happens with earnings, you could see some volatility in the markets with Nvidia being ballpark 6% of the S&P 500.
Yep. Good way of saying it. Let's transition to tweets, articles, and research from the week. I'll start off, Nick. My first topic is a reminder to our listeners and viewers about seasonality. And the topic I'm going to bring up is that from a seasonal perspective, the second half of September tends to not be very friendly to stock market or equity investors. So this first piece that I'm going to highlight is from an X post by Seth Golden on August 20th. He attached a chart where the underlying source, he said, was Goldman Sachs, and it shows the returns of the S&P 500 index going back to 1957 is what the post said. And Jen will put this chart up, Nick, for our YouTube viewers. This will be in our show notes for all of our traditional podcast listeners. And as a reminder to our newer podcast listeners, all of the show notes can be found in all of our social media sites for Jessup Wealth Management. So whether that's LinkedIn and that's Facebook, Twitter or X, they're all on there. This chart is showing the returns from a seasonality basis. And you can see the various months and the various days of the month. And you're going to see very quickly what's highlighted is the second half of September, going back to 1957, tends to be weak. I want to combine this, Nick, with the fact that the next Federal Reserve announcement on interest rates is currently scheduled for September 18th at 2 p.m. So you got that on top of it. Now, here's my disclaimer. Does this mean that the second half of September is going to be bad? No. I just want to inform our listeners and viewers that through the lens of history, this tends to be a seasonally weak period for the markets. Doesn't mean it's going to be that way this year, but I guess it would not be surprising. Presidential election year, on top of the fact we tend to have weakness in the second half of September. Just want to throw that out there for our listeners. Don't be surprised. But also, I would tell you, don't try to time this either. Nick, your thoughts?
Yeah, I agree with what you said. Don't be surprised, but don't try to time it.
Yeah.
The volatility that we saw this past month, like you said at the beginning of the podcast, where if you would have closed your eyes in July and woken up at the end of August, it would have seemed like no big deal, but obviously it was a lot of volatility, and I expect to see that. I think we all expect to see that
Ramp up closer to
the election.
Yeah.
So. By no means does that mean, like you said, second half of September is going to be weak, but it absolutely could happen.
Through the lens of history, the statistical probability, history tells you that's a strong possibility.
Absolutely.
So my next thing I want to talk about is a reminder about time in the market, Nick. Not about timing the market is what really matters.
That's a good follow-up.
How's that? How's my order? You like the order?
Yeah, that's good.
So this is an X post by Ryan Dietrich on August 18th. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. And this piece of research goes back 20 years to 2004, representative of the S&P 500 index. and it shows $10,000 invested at that point. And what it shows is the cumulative return on that $10,000, Nick, over that 20 years, being fully invested from day one. What happens when you miss the 10 best days in the market, followed by missing the best 20, followed by missing the best 30, 40, 50, and 60. And what you're going to garner very quickly is that attempting to time the market, you are running the risk that you are going to miss out on some big up days in the market, which could drastically affect your long-term rates of return.
Yeah.
I'm going to point out just the fully invested versus missing the 10 best days. The 10 best days over 20 years. Okay? To give you an idea, that is in rough math, you're probably talking 5,000 trading days, I could argue, somewhere around that number. And how I'm coming up with that rough math is there's about 275, 200 trading days in a given year, right? So being fully invested was a little bit over 63,000, that 10,000 turned into. And missing the 10 days, it dropped from 63,000 and change to 29,000 and change. Just missing the 10 days, best days, over 20 years. Your thoughts?
My initial thought is to point out to listeners that, and I'm assuming that this chart is assuming that you've liquidated that 10,000.
You were out of the market on those days.
Completely out of the market.
Yes,
So that's
and
the
you
first,
were back in the day after.
And you're back in the day
That's
after.
what the assumption I would make as well.
So that's one thing I would point out to investors is, it's you will see strategies. There's, depending on your risk tolerance, where okay, maybe you go like, let's say you're in a 60-40 model, for example. Okay, maybe you go heavier on the fixed income side at times. Portfolio allocation is different than getting in and out of the market. That's the first main thing I want to point out to listeners.
Mm-hmm.
When you're pulling everything out of the market and then jumping back in, you can clearly see that
it could be detrimental
it can
if
be
you miss those
detrimental.
big days.
It can be
to the upside.
detrimental to your retirement plan. I think the chart really speaks for itself.
Yeah, I thought it was very impressive and a good reminder. Again, attempting to time the market on a short-term basis is extremely challenging.
It is.
And you start to see the rewards about being in the market consistently, not trying to time it, to my opinion, is really what matters. And I think this is just a set of data that kind of justifies and backs up that viewpoint.
Absolutely. Stick to your plan. Right?
Stick to your plan.
Yeah.
So my next piece is more Americans, Nick, are owning stocks.
I saw this.
Did you see this?
Yeah,
this was a chart that B of A Research and Investment Committee had that I saw on X. It was a post by Global Markets Investor on August 25th. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. And this is, quote, a chart of household allocation to stocks. It's equities as a percentage of total household allocation. And we're at a point where we're back in the mid to high 50 range, similar to where we were leading up to the dot-com bubble in 2000. Hit a low, it looks like, around 30% or so during the great financial crisis and has slowly been recovering since. I take this as a positive. You now have an American population compared to history that's at a relatively good percentage of stock ownership. You have a lot of legislative changes over the last decade where people are automatically getting enrolled into 401k plans, and they have to take action to get unenrolled. But when you see this, Nick, what goes through your head?
The first thing that goes through my head is I think this is a good thing for society in general, especially with some of the changes that we've seen to labor markets in the past 20, maybe even more than that, let's say 50 years, as far as pension plans kind of going away and retirement being more and more on the end user. So I think it's good to see that number go up for society in general. It's one of the first things I think about. And the second thing I think about is the ease to access the markets, I think, is probably helping this as well. There's so many apps out there, and even the big wirehouses and financial companies make it easier to get involved in the market. as well as just general understanding of the financial markets, has increased as well. So I think it's kind of a combination of all those things that kind of run through my head there.
Yeah, well said. Well said. Those are the topics I have this week that I thought would be helpful to our listeners and viewers. What do you got for listeners and viewers this week, Nick?
Yes, the first topic I have is market action over the past month. It's an ex-post from Kevin Gordon. He's a senior investment strategist at Charles Schwab. He says over the past month, almost neck and neck returns for cap-weighted S&P 500, the Magnificent Seven, and the equal-weighted S&P 500.
Ooh, I love this.
Very interesting. We talk about, we've talked at length, and most market participants have, about the strength in the Magnificent Seven. We talked a little bit about some of that volatility that we saw in the beginning of July. So this chart that we'll throw up for you, it's not exactly like the beginning of July to where we are now. It actually looks like on the 28th of July. It's a month-over-month chart that goes until the 26th, so yesterday. And you can see, obviously, the Magnificent Seven really kind of leading that downturn in the beginning of July. But what really sticks out to me is really just the last kind of few days here, how close things are trading, and just in general, overall, everything is very tight. As opposed to what we've seen over the past couple of years, where the Magnificent Seven is really dominating price returns. So I think it's a very healthy thing to see. I actually really, really like it, which is why I brought it up. So
I love it, and I think it speaks to market breadth, and we've talked about that term on the podcast before. For our newer listeners, that's in regards to, let's just say, the percentage of stocks that are participating or well-performing versus the index. And we've had very few names relative to the last 40 years. I highlighted a piece of research on the podcast several weeks ago that showed we had the most narrow participation as a percentage of stocks beating the S&P 500 index going back 40 plus years.
Yeah.
And statistically, what tends to happen after those periods, and it could happen immediately, it could take a little while, but at a certain point, a lot of those maybe names that have been left behind that weren't performing well, you tend to see a rotation. And with the threat of lower interest rates on the horizon, there's different, say, market capitalizations or size of stocks that tend to do better in, say, a falling interest rate environment compared to others. And this might lead to more of a rotation from those mega cap Magnificent Sevens, potentially.
Yes, absolutely. I think I talked about something similar a couple weeks ago as well.
Okay, all right.
So that's good. We're covering this a couple weeks in advance, and we're kind of seeing a little bit of that, which is great.
Love that.
So hopefully people enjoy that chart. The second piece I have is on EPS revisions. This is a post from Liz Young. She's the head of investment strategy at SoFi. She says the following: 52% of 52% of EPS revisions for 2025 have been to the upside. While that's lower than post-recession and or cyclical acceleration periods, it's still a 65th percentile rank going back to 1985, and right where we were pre-pandemic. So what this chart shows is the S&P 500 upward EPS revisions as a percentage of the total. Kind of a funky chart, kind of a funky data point. It's interesting. The reason I wanted to point this out is because it's a kind of a different way to look at earnings estimates and how they're changing and where we are in the earnings cycle and if things are falling apart. And we've talked about that over the past few weeks of, hey, fundamentals are still pretty good. And this chart supports that. You're seeing more upward EPS revisions, which means all the analysts on the street who are projecting forecasts on the sell side research, they're saying, hey, we think EPS in the future is going to be higher. We're revising what we thought previously higher. So to see that number kind of in the middle of this chart, I think is very healthy, and I think it's a good thing. Your thoughts?
First of all, I think you did a great job explaining that. I'll add to it. As a reminder, EPS is earnings per share. I'm a big believer that a big driver of a stock price is the company's underlying earnings growth over time. And so if you have a company who is doing a real good job consistently growing earnings, especially above, say, the market average, you would tend to have some favoritism that stock's performance should be better than average, right? Because a number one determinant, in my personal opinion, is where earnings growth is coming from. Because Wall Street does a good job comparing what'd you do in the first quarter of last year and what'd you do the first quarter of this year, what's the year-over-year comparison. I think what you are now highlighting is, especially over the past roughly 2 months, the market has questioned where we are at in the economic cycle with the threat of lower interest rates. And is a downturn in corporate profits imminent? Well, the market shot first and asked questions later. Another way of saying it is it sold first. And I think so far, corporate America is telling us, based upon data such as this, that the underlying health of corporate America is not as bad as the market had feared in late July and early August, which is why I think you've seen the recovery in the equity markets over the past roughly 3 weeks. I think watching this data is going to be important to monitor corporate health. But I think what's going to be dominating headlines in the near future here is going to be a combination of what the Fed does in mid-September, along with the fact that things are going to heat up on the political news front the closer we get to Election Day. But I think it's a nice reminder for our listeners and viewers that looking at the fundamentals, things are not horrible or even as horrible as the market had feared just a couple of weeks ago. Doesn't mean it can't get there at any moment. But as of right now, the data is not supporting that.
Correct. Yeah. That's a perfect way to say that. I really can't add anything on that. That's perfect.
How was that?
I'm just going to move on to the next one.
All right.
All righty. My last piece here is also on earnings growth across sectors. This is actually two posts, two pieces of research from FactSet. I love these charts. I think it's helpful for listeners to see this.
This is great.
So
this plays perfectly into your last one.
It did. I did plan that out.
This is perfect.
So I like to just show this chart. I think we probably do this quarterly. So there's two charts here. One is S&P revenue growth year over year for Q2 2024. Now this is like factoring in this latest earnings season, which technically, like we mentioned at the beginning of the podcast, we're not completely done with that. There's
Correct,
still
sir.
a lot of chips to semiconductor chips to report. So this is not a complete picture, but we're pretty healthily through a big piece of the earnings season. So the first chart is S&P revenue growth year over year. And you can see the today numbers in blue and the number last quarter is in gray. Looks pretty healthy. No major turnarounds, no major shocks. I mean, you see a little bit of movement here and there, but quarter over quarter, everything looks pretty healthy. You have anything to add before we go to the EPS chart?
Just kind of looking at it, people wonder why over the past year, maybe the subsection of the market, the sectors such as technology has done well. The money's been following their earnings growth. And I think that's a big reason why the subsection of the market, the sector of tech has done well. And I've been doing this long enough to throw this out there that, when you have corrections, it tends to happen, it gets hit hardest in areas that have the highest expectations. So my word of wisdom is, if you look at a chart like this and think, well, this is easy, I'm just going to dump a significant amount of money into tech, this is a no-brainer because look at where the earnings growth is coming from. I'd argue at some point there will be a disappointment, meaning that the sector of technology will not maybe maintain this growth rate at a certain point. We have a downturn, and that's why those sectors get hit more.
And harder.
So I just want to throw that out there that I don't want this to be equated to, well, since that's the highest growing sector, it would make sense for me to have a massive overweight in that area. I think you need to look at that from a balanced perspective, because when we have the next downturn, not a matter of if, when, those loftier areas with higher expectations tend to get hit a little bit harder through the lens of history. Does that make sense?
That makes perfect sense. And tying that back to what we said at the beginning of the show, that's why we pointed out Nvidia reporting earnings on tomorrow,
well
right?
said.
Because they're one of those names that, if they were to underperform tomorrow, they're going to get hit, and they'll pull back.
Yes.
And if you put everything you had into, a few tech names and you weren't prepared for that volatility, it could be painful. So
well said.
Yeah. The second chart here that we'll throw up is just the same chart, but showing earnings growth instead. So kind of that underlying,
interesting.
That underlying piece, once you get past all of your operating margins and your expenses and all that. So
tell them what the number one sector is there.
Interestingly, the number one sector is utilities, and then, of course, information technology. So the chart's very similar, of course, to the revenue chart, but there are a lot of things at play here once you get down and you're digging into the balance sheets. So
yeah, very interesting to see utilities on top, and doesn't surprise me with power consumption going up and forecasted to continue to go up, especially with the utilization of data centers, and the AI usage alone could be a part of that narrative. But I think it's very, very interesting data sets, Nick.
Yes, yeah. So hopefully that helps investors and listeners feel a little better and have an even clearer point of the things that we've talked about over the past month with the health of corporate America. By no means are these charts screaming that corporate America is falling apart. So here's more data. We've talked about it probably 4 weeks running now.
Sure.
And this is very recent data, so listeners should feel good about these charts. They look healthy. Nothing's screaming and concerning. Like you mentioned on the last post there, some of the volatility that we might see over the next couple of months, I think, is gonna get down to the Fed and some of the political landscape, and then what we see kind of here in the next couple of weeks with the semiconductors and the AI trade, and so to speak. But regardless of what happens in between now and then, the 80% or so of earnings that we've seen are strong.
Yeah, that's good. Well said. And sometimes I get this question a lot from clients, and the question is, Matt, with all the news headlines you're seeing in the investment world and in the political world, what are some of your biggest concerns over the next year? And my response is pretty easy for me. I'm concerned about the ongoing stability and health of the American consumer. And where that mainly relates to, for me, is things on the employment front. Because the jobs numbers that a lot of people are looking at year to date, they're looking at a headline number of part-time plus full-time jobs. And I really feel that we got to keep a close eye on full-time employment, because we've had now several consistent months of full-time job losses. Mm-hmm. And at a certain point, that could start to affect consumer psyches. Yep. And with 2/3 of our economy consumer spending led, if you really had to pin me down, that's one of the areas that I think needs to be a big focus of investors over the next year. Not the sole data point, but definitely an important one that that's not a sexy thing to watch, right?
It's not.
It's not a sexy headline, and it doesn't get a lot of clicks online, but I definitely think it's an important topic that could be kind of a tell on where we're going with the economy. And you definitely see some concerns on the full-time job front. And I think investors need to be monitoring that, especially going into 2025. It would not surprise me to see continual job losses on the full-time front leading up to the election when the data comes out on the first Friday of every month. But I think as we go into 2025, if that's a trend that continues, no matter the outcome of the election, I think that should be something that investors should be concerned about. Mm-hmm. So I want to throw that out there because I do get that question quite often. And this is another reason why you got to listen to the entire podcast.
Yeah. To get the golden nugget at the end.
There it is. There it is. We do have a couple things I want to share. Blueberry promotion. We use Blueberry as our podcast hosting site. And we get a lot of questions about people wanting to start their own podcast. How do you guys do it? Where do you guys host your stuff? So if you want to create your own podcast, you can check out Blueberry. That's spelled Blubrry. You can use promo code Jessup Wealth to get your first month of Blueberry podcast hosting for free. You can go on their hosting estimator on their website, choose the ideal plan. Again, you'll receive your first month with promo code Jessup Wealth, all lower cases, no spaces. And in addition, part of the summarization of these podcasts, we use a piece of AI software to help us do that. It's called Firefly's AI software. It can help you summarize meetings, take notes. You can use the link in our show notes, Nick, to look at a potential subscription there, make life a little bit easier. I know I just had some final thoughts. I'll leave final thoughts with you, Nick, before we sign off.
I think you kind of nailed it today. So I'm not gonna add anything. I hope listeners enjoyed it, and we'll hopefully see you next week.
Well, I hope everyone has a good holiday weekend coming up, good Labor Day weekend with friends and family. I have a feeling, at least in the Midwest, this heat is going to continue. My wife is not very happy about the heat wave right now. She got a taste of fall, which is her favorite time of the year, and is not a happy camper. So thank you for listening to episode 267 in the Independent Advisors Podcast. Me, Mark, Nick, Aaron, Jenna, Taylor, we'll be back next week for episode 268.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.